Have you ever noticed how some people seem to be playing a different game with money? While most people work, pay bills, try to save a little at the end of the month, and constantly feel behind, there is a minority that gets richer almost silently, making decisions that seem obvious, but that almost no one notices. What's interesting is that most of the time, it's not about off-the-charts intelligence or being born into a rich family. What really changes is how these people see the world, interpret situations, and respond to the stimuli around them. In other words, they use psychology in their favor, while most people are used by their own minds without realizing it. This video will show the 7 psychological tricks that billionaires use all the time, and that have very likely already been used on you without you noticing. The difference is that once you understand these mechanisms, you can stop acting on autopilot and start making financial decisions in a much more conscious way. To make this concrete, we're going to use as reference the mindset of Charlie Munger, Warren Buffett's longtime business partner, an investor who lived to 99 and spent decades studying not only numbers, but also something he considered even more important: the ways people deceive themselves psychologically and destroy their own financial future. Munger used to say in practice that a large part of financial success comes not from doing brilliant things, but from consistently avoiding the obvious mistakes most people make. He deeply studied what he called bad human psychology, biases, illusions, mental traps that push people toward bad decisions. While most people fall into these traps, he looked for ways to recognize them and protect himself from them. In this video, you'll see how some of these mechanisms work, how billionaires use them when investing, negotiating, and deciding where to put their time and energy, and especially how they influence your everyday choices, often without you noticing. If you're someone who works, pays your bills, tries to organize your financial life, but feels like something is always slipping through your fingers, as if you were in a race where money comes in and goes out too fast, pay attention. Maybe what's missing is not just earning more, but seeing more clearly how your own mind has been sabotaging you. Throughout this video, each psychological trick will be explained in a simple way, always with 2 sides. First, how it's used strategically by investors and billionaires. Second, how it usually works against you in your spending, your investments, and your life decisions. In the end, the goal is not that you suddenly start thinking like a billionaire overnight, but that you're able to recognize patterns and say more often, "Wait, there's a psychological trick at play here. I'm not going to react on autopilot." So if the idea of understanding what's happening behind the decisions of those who get rich and behind your own choices makes sense to you, keep watching. The first psychological trick is one of the most dangerous precisely because it gives you the feeling that you're right, even when you're walking in the opposite direction of what you say you want to achieve. Trick number 1, confirmation bias, the trap of only hearing what you want. The first psychological trick you need to understand is confirmation bias. Simply put, it's the tendency every human being has to search for, value, and remember more the information that confirms what they already believe, and to ignore or downplay anything that goes against their opinion. Billionaires, seasoned investors, and people who make good financial decisions know this bias is extremely dangerous. That's why they develop the habit of questioning their own certainties. Instead of looking only for arguments that reinforce what they've already decided, they actively seek opposing points, criticism, and data that could dismantle their thesis. It sounds counterintuitive, but that's exactly what raises the quality of their decisions. Charlie Munger repeatedly said, in practical terms, that you shouldn't consider yourself prepared to have a strong opinion until you're able to explain the opposing side just as well as its defenders. In other words, before defending an investment, a business idea, or a big expense, you need to deeply understand the reasons why it might go wrong. In most people's lives, the exact opposite happens. When someone decides, for example, that investing is too risky, they start paying attention only to stories of people who lost money, scams, and negative market headlines. Silently, they ignore all the stories of ordinary people who invest with discipline and build wealth in the long run. Likewise, when someone decides that I just can't save money, Everything around them seems to prove that narrative. Inflation, unexpected expenses, surprise bills, rising cost of living. Almost never does this person honestly look for examples and strategies from people who earn roughly the same but manage their finances more effectively. Billionaires use their understanding of confirmation bias in two ways. First, against themselves. They cultivate the discipline of seeking contrary opinions, talking to people who think differently and analyzing data that challenge their initial conclusion. Second, by observing others. They know that the crowd tends to seek only what confirms their emotions in the moment. And this creates opportunities. For example, when the market is euphoric, full of positive news, most people only see reasons to buy more of the same. Few want to hear about risks, overpriced assets, or excesses. When fear takes over and everything seems to be collapsing, people look only for news that confirms this sense of panic. Those who understand this psychological cycle manage to keep a cool head and act rationally, even when the environment is dominated by emotion. In your daily life, confirmation bias may be at work when you decide that you weren't born for numbers and avoid any deeper financial content. Believe that all rich people are dishonest, and therefore ignore examples of people who became wealthy through serious work, study, and the long term. Are convinced that starting a business is too risky and only pay attention to bankruptcies, never to small businesses that have succeeded around you. From now on, whenever you're about to make an important financial decision, taking on debt, making an investment, accepting a business proposal, pause and ask yourself, am I actively looking for arguments against this or just trying to prove that I'm right? This simple question doesn't eliminate confirmation bias because it's part of our nature, but it increases the chances that you won't fall into illusions that could have been avoided with a bit more intellectual humility. That's what many rich people have learned. It's not about being right all the time, but about making fewer mistakes on decisive points. The next psychological trick is directly related to how we look around us to decide whether we're on the right track. It influences how you spend, invest, and even how you define what success is. And once again, billionaires use this human tendency not to follow the crowd, but to understand when not to do what everyone else is doing. Trick number 2, social proof. When everyone does it, becomes a trap. Human beings learn by observing. From an early age, we look around to understand what is right, what is desirable, what is dangerous. That's useful in many situations. The problem is when this tendency turns into autopilot and starts to drive important financial decisions. In practice, social proof is that silent voice that says, if everyone is doing it, it must be the right thing. If no one I know invests, investing must be way too risky. If my friends spend like this, it's normal for me to spend that way too. Billionaires and major investors understand this mechanism deeply. They know that when most people are running in the same direction, they rarely stop to think. People follow the line, repeat behaviors, copy lifestyles, subscriptions, installment payments, simply because that seems to be the standard. Over the years, Charlie Munger observed how the masses tend to go to extremes. When something seems to be working very well, everyone wants in, even without knowing what they're doing. When something goes wrong, everyone wants to run away, often selling or abandoning assets that, with calm, could be kept. Think about how many times you've made a financial decision just because you saw many others doing the same. You bought a trendy product because it was everywhere on social media. You accepted a credit offer because everyone uses that card. You didn't invest because no one in your family or circle of friends invests. Social proof also shows up subtly in lifestyle. If your circle of people lives at the credit card limit, constantly changing phones, traveling on installments, changing cars like they change clothes, that starts to feel normal. You don't feel you're overdoing it because you're just keeping up with the standard. Duh! Billionaires use this understanding of social proof in two ways. First, to avoid being dragged by the euphoria and panic of the crowd. They know that when everyone is too excited, It's time to be more cautious. And when everyone is too afraid, there may be opportunities. Second, they see how businesses, products, and services can benefit from herd behavior, and they build companies that leverage this strategically. In your life, social proof may be sabotaging you when you feel you need certain objects or experiences, just so you don't look like you're falling behind. Adjust your spending pattern to match people who often are in debt but keep up an appearance of abundance. Avoid seeking financial knowledge because no one around you talks about that. A simple question can help protect you from this trap. If I had no idea what others are doing, would this decision still make sense to me? When you answer honestly, you realize that part of your choices isn't based on logic, but on the fear of missing out, being judged, or seeming different. Anyone building solid wealth needs, at some level, to accept being weird in the eyes of most people at certain stages of life. In the next trick, we'll talk about something even deeper, the fear of losing. It's such a strong force that it often makes you avoid real growth opportunities, just to avoid the discomfort of a small risk. And this is exactly where the mindset of very rich people radically distances itself from how most people see money. Trick number 3, loss aversion. The fear that keeps you from growing. Human beings generally feel more pain losing a given amount of money than pleasure gaining the same amount. Losing 100 reais usually hurts more than gaining 100 reais brings joy. This difference in intensity makes many people run away from any situation in which there is risk, even when the potential gain is much greater than the risk involved. Billionaires understand that this fear is natural, but they learn to put it in perspective. They don't try to eliminate risk entirely, but to choose calculated risks in situations where the relationship between possible loss and potential gain is clearly favorable. Charlie Munger and Warren Buffett, for example, avoided random bets, but were not afraid to invest large amounts in businesses they understood well, even when the scenario looked uncertain to most people. They preferred to face the risk of small, short-term fluctuations in exchange for big, long-term results. Most people, however, act in the opposite way. They refuse to learn about investing for fear of losing everything, but accept naturally the certain and silent loss that comes from leaving money parked, earning little, while inflation erodes its purchasing power. They avoid a conservative investment with some volatility, but easily take on expensive credit card or overdraft debt. Loss aversion also shows up when someone prefers not to look at the full bill out of fear of what they'll see. Avoids checking their real financial situation to escape the need to change habits. Rejects an opportunity to earn more in the long run because there's a chance of earning a bit less for a while. Billionaires use their understanding of this tendency very objectively. They accept that losses are part of the game, as long as they are controlled, calculated, and offset by bigger gains over time. Instead of seeking absolute safety, they seek a margin of safety, a buffer, a cushion, some slack between what can go wrong and what they can handle. In your life, this may mean studying enough so that you no longer have irrational fear of simple, solid financial products. Accepting that, to move forward, you may need to give up some immediate comfort, a recurring expense, to build an emergency fund that protects you from surprises. Understanding that there is no scenario where you run zero risk, even standing still is a risk in itself. A question that can help you here is, what is the risk of me doing nothing? Because many times, loss aversion makes you see only the risk of acting and completely ignore the risk of staying exactly where you are. The next psychological trick is about that very thing. How our commitments and habits tie us down. Those who get rich tend to use commitment and consistency in their favor. Those who stay stuck tend to use the same mechanism against themselves without realizing it. Trick number 4, consistency and commitment. The power of repeating what's right. When a person takes a public stance, makes a decision, or adopts a habit, there is an inner force that pulls them to keep acting in line with that, even when it no longer makes much sense. This happens because we like to see ourselves as consistent. Billionaires and great investors have learned to use this in their favor. Instead of relying only on momentary willpower, they create clear commitments, routines, and structures that push them, day after day, toward better decisions. Charlie Munger often talked about the importance of simple, good habits repeated for a long time. Reading every day, avoiding bad debt, thinking long term, maintaining discipline. None of this looks extraordinary on any single day. But over years and decades, the accumulation of consistency produces results that from the outside look almost unbelievable. In most people's lives, the same consistency mechanism works in reverse. If someone, for example, defines themselves as terrible with money, they start acting in a way that matches that identity. They don't study the subject, don't organize their bills, don't plan, don't change. The commitment is not to the desired result, but to the image they have of themselves. The same thing happens with small habits. Those who get used to going a bit over their credit card limit every month begin to see that behavior as normal. Those who always buy in installments start believing there is no other way to consume. Those who never invested feel that it doesn't make sense to start too late and repeat that narrative year after year. Billionaires, on the other hand, choose more carefully which commitments they tie themselves to. They know that once they take a certain stance, they're likely to keep going in that direction. So they try to commit to principles that work well even over many years. Spending less than they earn, investing regularly, studying continuously, saying no more often than yes to offers that don't fit their strategy. In your life, using this trick in your favor may mean clearly committing to always save a portion of your income, even if small, every month. Creating the habit of tracking your expenses, however simply, so you can see where your money is going. Deciding that, from now on, you won't take on consumer debt without a conscious reflection. By doing this, you stop depending solely on isolated decisions and start using your own tendency toward consistency as an engine. Instead of fighting yourself every day, you build a path where repeating the right thing becomes easier. The next psychological trick we'll explore has a lot to do with modern consumption. How an initial number shapes your sense of expensive or cheap, fair or abusive. It's called the anchoring effect, and it influences your life more than it seems at first glance. Trick number 5. Anchoring effect. When the first number controls you, the anchoring effect happens when an initial number or piece of information becomes a kind of reference point in your mind, strongly influencing all your evaluations from that moment on. Billionaires and good negotiators know that whoever sets the first anchor, the first number, the first offer, the first comparison, usually has the advantage. That's because even if the other side tries to adjust, negotiate, or bargain, they tend to remain attached to that initial point. In daily life, the anchoring effect shows up when a product is shown with a high price crossed out and a lower price beside it that looks like an unmissable deal, even though it's still expensive. You compare your salary not with what you actually need or what's fair for your work, but with the first amount you earned in your career. A monthly fee seems acceptable simply because other options shown before were even higher. Billionaires use this understanding strategically. When analyzing opportunities, they don't let themselves be swayed just by the first impression of price or promised return. They look for other references, compare using objective criteria, and question the initial anchor. In negotiations, they often establish the first reference point for value, knowing this tends to guide the entire conversation. In your financial life, the anchoring effect may be hurting you when you accept a high fixed cost because at the time you signed, another, even more expensive option was shown, making the current one seem reasonable. You believe it's worth it to maintain a certain lifestyle because you've gotten used to that level, even if it's keeping you in debt. You dismiss consistent investments because you anchored yourself on stories of extraordinary, unrealistic returns, and anything that doesn't look explosive feels boring or not worthwhile. A practical way to protect yourself from this trick is to ask, if I hadn't seen this first price, would I still think this is fair? Or what would be a truly rational reference to evaluate this price, this investment, or this expense? By asking this kind of question, you start loosening the mental anchors that were placed in you by advertising, family habits, consumption patterns, and you begin to make decisions more aligned with your reality and your long-term goals. The next psychological trick is related to time. Not just clock time, but our relationship with patience, boredom, and delayed rewards. It's here that the gap between the mindset of those who get rich and that of most people becomes even more obvious. Trick number 6. Time, boredom, and compound interest. The game almost no one is willing to play. The sixth psychological trick has to do with time, boredom, and the ability to delay rewards. Most people underestimate what they can build in 10 or 20 years, and overestimate what they can achieve in a few weeks or months. This constant impatience makes them act as if the only time that matters is right now. Billionaires see time differently. They understand that in finance, the most powerful factor is not the amount you have today, but how long that amount is put to good use. That's where compound interest comes in. Gains on top of gains, growth on top of growth, in a process that seems slow at first, almost irrelevant, but becomes impressive after many years. Charlie Munger and Warren Buffett built much of their wealth not through spectacular high-risk moves, but through reasonable decisions, repeated with discipline over decades. They accepted something most people hate: the boredom of investing consistently in solid assets, without constantly changing direction for every new fad. Most people, on the other hand, are attracted to the exact opposite. They want something that changes their life quickly, that turns a little into a lot, in an almost magical way. This makes them easy prey for get-rich-quick schemes, scams disguised as opportunities, and investments with no real basis but seductive promises. The problem is that in constantly chasing the extraordinary, many ignore the power of the ordinary done well. Putting aside part of your income every month, investing regularly, increasing contributions whenever possible, avoiding expensive debt, maintaining a lifestyle within your means. None of this is exciting, but it's exactly the kind of behavior that builds freedom over the years. Billionaires use the psychology of time this way. They accept that meaningful results take time. They don't let themselves be driven by the anxiety of nothing seems to be happening in the short term. They trust the math of compound interest, as long as their strategy is solid and their discipline steady. In your life, this trick can work in your favor when you stop expecting every financial decision to change your life immediately. Choose a simple, safe strategy that fits your profile, and stick with it long enough. Understand that very often the big turning point comes from the sum of small right decisions repeated over years. A useful question here is, if I keep this financial behavior for the next 10 years, where will I be? This question shifts your focus from the impulse of the moment to the accumulated effect of your choices. It's exactly what many people don't want to do, because it forces them to face the gap between their habits and their goals. The next psychological trick closes the picture by looking at something often underestimated: your environment, the people you spend time with, and the culture around you. Billionaires know that no one thinks completely independently. That's why they're very intentional about choosing the influences they expose themselves to. Trick number 7. Social circle and environment. The psychology of who you surround yourself with. Human beings are deeply influenced by the people they live with. Values, habits, opinions, beliefs about money and work are largely absorbed from the environment. Even those who consider themselves independent usually, without realizing it, reproduce patterns from the group around them. Billionaires and people who are very successful financially tend to be extremely selective about the influences they allow into their lives. It's not about looking down on anyone, but about understanding that your environment can be a huge accelerator or a huge brake. Throughout his life, Charlie Munger chose to surround himself with people who valued logical thinking, ethics, patience, constant learning, and long-term vision. This created a kind of psychological force field. Conversations, examples, decisions, everything pushed in that direction. In most people's lives, something similar happens, but often in the opposite direction. If your circle normalizes constant debt, status-driven consumption, lack of planning, and jokes about people who are too tight with money, it's very likely you'll feel invisible pressure to fit in. Even when you realize something doesn't make sense, it's hard to swim against the current all the time. This influence shows up when you feel embarrassed to say you won't go to an expensive event because you're prioritizing other goals. Someone in your group starts doing something different, like investing, and is seen as weird or over the top. Talking seriously about finance seems out of place in your conversations. Billionaires use this trick in their favor by deliberately seeking environments where it's normal to talk about projects, investments, and learning. Gradually stepping away from circles where the pattern is constant self-sabotage. Reading authors, studying people, and following examples that reinforce the mindset they want to have. In your life, this doesn't mean abandoning every relationship, but adding new influences. It can be through books, content, study groups, communities, and friendships that pull you upward. Over time, you start noticing that choices which once seemed crazy, like spending less than you earn, planning your future, and avoiding debt, become the new normal within that environment. A question that can guide this reflection is, if I stay surrounded basically by the same references for another 10 years, I'll probably end up similar to whom? And then, is that really the direction I want for my financial and personal life? When you understand this psychological trick, you realize it's not enough to change just techniques or investment strategies. At some point, you'll also need to adjust the environment in which your mind is shaped every day. Throughout this video, you've seen 7 psychological tricks that billionaires use, and that have often been used on you without you noticing. Confirmation bias, which makes you look only for what reinforces what you already believe. Social proof, which pushes your decisions toward wherever the majority is going, even if they're lost. Loss aversion, which magnifies your fear of taking risks and hides the risk of standing still. Consistency and commitment, which can keep you stuck in bad habits or sustain good habits for decades. The anchoring effect, which shapes your sense of cheap, expensive, fair, or absurd based on a first number. The way you deal with time, boredom, and compound interest, and the deep impact of your social circle and environment on your view of money and the future. The common thread among all these mechanisms is simple. They're at work all the time, whether you're aware of them or not. Billionaires, great investors, and people who build consistent wealth are not immune to these biases. The difference is that they've learned to recognize them and use them as tools instead of being dragged around by them all the time. From now on, the most important question isn't how do billionaires think in the abstract, but how are these tricks operating in my life today? In my decisions, my habits, and the people I surround myself with. You may realize that, more than a secret formula, what was missing was clarity on how your mind works in practice. And from that clarity comes the possibility of changing small things, questioning an old belief, revisiting a habit, looking more carefully at a decision that seemed obvious, adjusting the environment around you. If this video helped you see at least one of these points differently, it was already worth your time. And if you want to keep going on this journey of understanding the mind, money, and the choices that really build wealth, here's an invitation. If you watched up to this point, this content probably made sense to you. So take a moment to like this video now. That tells the platform this topic is relevant and helps this type of message reach more people who are also trying to escape the cycle of working, paying bills, and never feeling like they're moving forward. Also, make sure to subscribe to the channel. Here the goal is always to bring serious, direct and practical content about mindset, financial psychology, and decisions that can change the course of your life in the long term. And if you want to take the next step, as soon as this video ends, watch the one that's on the screen right now. In it, you'll see how ordinary people who weren't born into rich families start applying simple principles to organize their finances, invest intelligently, and gradually build their freedom. Thank you for staying until the end. Use these tricks not to manipulate others, but to stop being manipulated by impulses, fears, and invisible pressures. See you in the next video.